My name is Hayden Sorwell, and this is my project on the cash conversion cycle between Amazon and Barnes & Noble. What is the cash conversion cycle? The cash conversion cycle is a metric that expresses the time, measured in days, it takes for a company to convert its investments in inventory and other resources into cash flow from sales. And this can be calculated by finding the inventory conversion period and then adding the receivables collection period and then subtracting the payables deferral period to get your cash conversion cycle. Here's a more in-depth look at our conversions. The inventory conversion period is the time required to obtain materials for a product, manufacture it, and sell it, which can be found by dividing daily sales from inventory. The receivables collection period is the time it takes for a business to receive payments owed. This can be found by dividing daily sales from accounts receivable. And the payables deferral period is the average length of time between when a company purchases supplies, materials, and labor on accounts payable and when it pays for them. And this can be found by dividing daily sales from accounts payable. Here's some of the financials from Barnes & Noble's income statement. Annual sales of $3,662,280,000. Daily sales of $10,033,000.64. Cost of sale, or cost of goods sold, of $2,551,077,000. And daily sales of $6,989,000.25. Some of their financials from their balance sheet of their inventories, $958,196,000, accounts receivable of $64,562,000, and accounts payable of $458,896,000. To look at Barnes & Noble's cash conversion cycle, so first we found the inventory conversion period to be 95.50, which we then add to the receivables collection period of 6.43, which we then subtract from the payables deferral period of 65.66, and we get a cash conversion cycle of 36.28. This means it takes Barnes & Noble 36.28 days to convert their investments in inventory into cash flows from sales. Here's a look at Amazon Corporation's financials from their income statement, which I got from their 2018 10K. Their annual sales were $232,887,000,000. Daily sales of $638,046,000.58. Cost of sales or cost of goods sold of $139,156,000,000. And daily sales of $381,249,000.32. Some of their financials from their balance sheet. Inventories of $17,174,000,000. Accounts receivable of $16,677,000,000. And accounts payable of $38,192,000,000. In-depth look of Amazon's cash conversion cycle. We came to an inventory conversion period of 26.92, and we add that to the receivables collection period of 26.14, and then we subtract the payables deferral period of 100.14, and we came to a cash conversion cycle of negative 47.12. And this means that it takes Amazon negative 47.12 days to convert their investments in inventory and other resources into cash flows from sales. Comparison. What's the factor that's responsible? The main factor that's responsible for these differences is basically the way that they do business. Barnes & Noble is a majority physical retail, and Amazon conducts their business online using e-commerce. And you can see that here is for Amazon. Their inventories as a part of their annual sales only makes up 7%. And you can see for Barnes & Noble, their inventories as a part of annual sales makes up 26%, which is a 19% increase from Amazon to Barnes & Noble as far as inventory is concerned. Results. For Barnes & Noble, their cash conversion cycle is 36.28 days. This is a consequence of doing business in retail because they have physical stock of books in their store, which means they have a 19% higher inventory than Amazon, and they are simply not able to sell their inventory as quickly as Amazon because they have to meet that inventory of sales, unlike Amazon. For Amazon, their cash conversion cycle is negative 47.12 and is firm specific because they are mainly an e-commerce company. Although they sell items you can find in a retail store, a lot of the items they sell, they do not house and come from third-party sellers, which they inventory. Furthermore, the cash conversion cycle being negative means that they're generating revenue from customers before they have to pay for their inventory. Thank you.